Welcome to the Long-Term Investor. Today, I have with me the founder and chief investment officer of Ritholtz Wealth Management, author of the Big Picture blog, and more importantly, the new book, How Not to Invest. Barry Ritholtz, welcome to the show.
Thank you so much for having me.
I think I've told you this in person. You are probably the person most responsible for me wanting to start a blog and then subsequently wanting to start a podcast. You've written thousands of articles. You've recorded hundreds of podcasts. You were really one of the first people to have a big podcast. For those of you listening or watching, if you don't subscribe to Masters in Business, absolutely the best out there. You're a tremendous interviewer. And so I want to start pretty high level. Maybe share with us a little bit. How did you develop your investment philosophy over time?
A lot of it is trial and error. A lot of it is reading. A lot of it is kind of starting out a little naive and gullible. And I learned over time that we as human beings are social primates who evolved and adapted to be cooperative. So we tend to believe the sort of bullshit that comes our way because for the past 2 million years, other than the past couple of hundred, look, we are soft, chewy, delicious creatures without armor, fangs, or claws. The only way we've survived as a species is as an intelligent, cooperative social group. So someone's always at the edge of the pack of chimpanzees warning about leopards, and that's hardwired into our, unless you want to call it soft-wired into our wetware. We tend to believe stuff we hear. And so, being kind of gullible and naive and listening to quarterly calls where the CEO or CFO talks about, oh no, this quarter is just an aberration. We see the orders. We have clarity the next quarter. It's all great. And you kind of figure out, oh, everybody is selling you something. If you don't at least ask the question, do they have my best interest at heart? What are they pushing? You kind of leave yourself vulnerable to a lot of nonsense. And so all of the columns were just kind of exploring that. The podcast was trying to learn more as opposed to the sort of nonsense we hear on a lot of TV or radio. What's your favorite stock? When's the Fed going to cut? Where's the Dow going to be in a year? So everything evolved over time. Some of it was trial and error. Some of it was just, hey, wait a second. Let's go back to first principles. Why are we doing it this way? And when you do that, you kind of learn that a lot of it is just nonsense.
You mentioned nonsense, and something, a big topic within the book was just the fact that predictions and the experts who make these forecasts are just such a big part of the financial ecosystem. And I think most people of any intelligence level would agree, nobody can predict the future. But as you put in the book, I think it's, quote, nobody knows anything. Right. People just seem to gravitate towards prediction in finance more than anywhere else. Why is that?
So there's 3 bullet points on this, why we believe people, some of the dumb things we believe. But just roll back a little bit and think about, I'll share a quick anecdote that's not in the book. So a buddy of mine used to do back in the day, the Business Week would have a year ahead forecast, and every strategist and economist on Wall Street would predict the S&P, the NASDAQ, the Dow, interest rates, the 10-year bond, inflation, the price of oil, things like that. And a buddy was sort of on a garden leave between firms and didn't feel comfortable doing it without the protection of a firm, so he asked me if I wanted to. And I had just written a piece called The Folly of Forecast that looked at it. Hey, whatever annual forecast you look at, it's always a different winner each year. You would think if there was some skill set, hey, Michael Jordan and the Bulls won 6 NBA finals. So maybe there's some skill involved. But if it's completely random, perhaps it's more luck. So he introduces me to the editor of, this was Business Week before Bloomberg bought it. And I give her this pitch. Hey, how about some alternative programming and why you need to take these predictions with a grain of salt and why you should never marry your portfolio to any one forecast. And I'll never forget this editor says to me, look, it's a big double issue. Do you want to participate or not? And I had just done an analysis of the Dow based on Reinhardt and Rogoff, who said leverage-based credit crises lead to a 32% drop in real estate. And so based on that, at the time the Dow was 14,000, I said, if their analysis is right, we could see, last paragraph, we could see Dow 6,800. The whole thing was all about risk and how real estate driven the economy in the 2000s were and how abnormal it was. It wasn't a forecast. It was strictly, let's war game a range of possibilities. And no one wanted to talk about the analysis. All they wanted to talk about was Dow 6,800. So I think that was like the end of '06. So throughout '07, I'm the idiot with Dow 6,800. And then suddenly by the beginning of 2008, I had been doing Kudlow and Kramer once or so a month, which became once a week, which became twice a week, which became constant. And suddenly that guy Ritholtz is a little bit less of an than we thought. But just stop and think about that, what that means. First, it tells us that people are really hungry for specific forecasts, right? If I go on TV and take the other position, hey, listen, a year ahead is so far out and so random. No one had a global pandemic closing the economy down in December 2019 and their year ahead. Oh, and the market would rally 69% off of the lows in 2020 and do 28% the following year. Nobody had the Russian invasion of Ukraine or the Gaza-Israeli war, any of those things. Like every year, 12 months is so long that a random event will easily disrupt the best intention forecast. And so when you say that to an audience, so let's assume the average return 9-10% a year, plus or minus, with dividends reinvested. We're at 5,000. All right, 5,500 next year, plus or minus, right? The guy, and they say thanks, and then they go to the other guy and say, what do you think? Well, I think the Dow is going to end up at 5327.5, and here's why. The audience loves that. The more specific, the better. Think about us in caves, and let's go get that woolly mammoth, and here's what we're going to do. We're going to go down, and where like people want leadership, they want specificity. Nobody wants to believe that the universe is random, or at least filled with random events. We hate that. And so they want the specific guy, 5327.5, the old joke about economists. Why do they use decimal points? To show they have a sense of humor, because it's so ridiculous. But we want that specificity. And by the way, if the person speaking happened to have had a huge outlier in their career and got one right? Think about people like Mario, Michael Burry, or there's a handful of other guys who were right once in their career, and now they just keep going back to that well. By the way, Burry doesn't trade that way. That was just how he spoke about risk. He's still a fantastic investor, but don't pay attention to his tweets. They're not going to make you money. The same is true for all these other guys, Sam Zell and Robert Kiyosaki and, Nouriel Roubini, and all these people who have had these outlier forecasts. They're more likely to be believed by the audience, and they're more likely to be wrong. So, it's just human nature. The more specific, the better. The greater the outlier, the better. And all of those add up to a really terrible track record.
Well, let me dig in there a little bit. You just named some people who tend to draw headlines, and individual investors, even advisors, will sometimes overweight the opinion when they see a Robert Kiyosaki you mentioned, or a Tony Robbins, or a Dave Ramsey. These celebrities or these financial gurus, so to speak, often have extreme views. What red flags should investors be looking for to identify potentially harmful financial advice when looking at experts?
Sure. So the first one is the word guru. I'm going to quote Bill Bernstein, who gets a chapter in the book. We use the word guru because charlatan is too difficult to spell. And I don't think all those guys are charlatans. I think, though, that we should really have our guard up. I mentioned Sam Zell. He made all his money in real estate by buying solid assets deeply distressed. It had nothing to do with timing recession. Kiyosaki wrote what is arguably the best-selling book in all of finance, Rich Dad, Poor Dad, and 32 million copies, some insane number. Someone else on another research shop has put together every forecast he's tweeted over the past 15 years. since the '09, and he's been nothing but wrong. I don't mean a little wrong. I mean like, oh my God, this guy is burning cash by the ton. My favorite is probably 2018. Now is not the time to buy U.S. real estate. I mean, other than the depths of the financial crisis, 2018 was a fantastic time to buy U.S. residential real estate. He's been forecasting a crash. He's been forecasting all sorts of stuff. And he's got like, I don't know, 3 million followers. That means there are 3 million people who don't know a whole lot about what's going on in the world. But as the head of my trading desk used to say, can't save everybody. Someone's got to be on the wrong side of the trade. And that's really harsh, but it's true. And so we see all these people. Plus, don't forget, the media is not a public service. It's a business. So clickbait, I mean, how many New York Times headlines have you seen with the same clickbait format? I'm an oncologist, or I'm a this, or I'm a that. Here's why you need to do that. I just saw one. I'm an oncologist. Here are the 13 things you can do to reduce your chance of getting cancer. It's like, holy, that's a really powerful piece of clickbait. And then I started noticing it coming up again and again. And, you know, one of the things that as someone who's published over the years, Street.com, Washington Post, Barron's, and most recently Bloomberg, you learn the headlines are written by an editor. You can submit a 1,000-word column. Someone else is going to muck it up with a clickbaity headline, and suddenly you look like an idiot. But that's just the nature of it.
You know, the editor writing the headline is one of the most important lessons I learned when contributing for the Wall Street Journal on a weekly basis. You know, they want the clicks. And I think, yes, the media is not on our side. You know who I also don't think is on our side, and you are uniquely positioned to chime in on this, are the billionaires who are often in the media. And you have interviewed, I don't know, several dozen billionaires on your podcast.
Quite a few. And I just keep saying, just give me 0.1% of 1% of your money. Yeah. I will take care of it.
Don't we all feel that way?
Yeah.
Well, this is a slightly different group of people who would be the gurus or the charlatans. You know, I think in general they mean well, but their situation is so different. So, I mean, I want to ask you, someone who's had deep, thoughtful conversations with a number of not just billionaires, but wildly successful investment managers. When you see an insight or a soundbite from one of these people in the media and you are an individual investor, or again, if you're a financial advisor, how are you thinking? What questions are you asking in your mind to help interpret the information that they're putting out there in the world?
So two things come to mind about that. The first is I was surprised how many billionaires talked to me about the role of luck and serendipity in their lives, which the first time someone gives you that, it kind of smells like, oh, this guy's blowing smoke up my behind. But, you know, after you hear it from Howard Marks and Ray Dalio and Lee Cooperman and over, suddenly it's like, oh, you know, I'll never forget I had a conversation with Howard Marks on the pod. He's been on the podcast half a dozen times. Scott Galloway is another one. And Howard brings it up. I'm like, Howard, not for nothing. You went to undergraduate here. You were a star at the Columbia Business School. You launched this fund. You launched a special distressed asset fund in the heart of the financial crisis. That's not just luck. That's skill. That's hard work. And he said, I went to Columbia Business School with Mario Gabelli, Lee Cooperman, his Art Sandberg, his carpool is just insane. And he said, everybody who was there was smarter than me. We all worked super hard. I wasn't outworking any of them, but sometimes right place, right time, right opportunity, not everybody gets that. And there's no doubt that that's true. So that's number one. The second thing that kind of comes along is the role of humility and constantly having to check yourself. And I am probably not the right spokesperson for the art of being humble because, my own neurodeficits and overcompensation for being an introvert in high school have led to this whole other persona, which my close friends know is nonsense. But it's fascinating to hear this over and over again. David Dunning of Dunning-Kruger, professor at University of Michigan, psychology professor, and really just helped drive the behavioral finance field forward, said, if you're not looking back at your work every 2, 3, 4 years and don't think, wow, this is a piece of shit I wrote 5 years ago, you're not progressing. And here's a guy who's got this entire subfield of behavioral economics named after him, the Dunning-Kruger effect. And even he is saying, hey, your work 5 years ago should be crap because you should be getting better and better. That's incredibly humbling to turn around and say, all right, I guess maybe, I kind of blame the whole Wall Street training program, which is about a week of modern portfolio theory and asset allocation, and here's how to build a bond ladder. And so after that week, it's 51 weeks of sales training. And a big part of sales training is just fake it till you make it. When I was coming up in the 90s, every jackass retail stockbroker I knew had a Rolex Submariner. And I'm long-standing watch guy from my Snoopy Timex to nicer watches, but I've always detested the Sub because it just reminds me of every hard-selling, fake it till you make it sort of guy. I think it was part of the sales training. Go buy yourself a flashy-looking watch, even if it's the cheapest Rolex, because that's the persona you want to project. And so that's led a lot of people to forget, hey, it's okay to say, I don't know. It's okay to say, I don't have this information at my fingertips, but I'll circle back with you over the next 24 hours because someone in my firm can get you this tax information, this stock information, this allocation question, whatever it is, we have access to the answers, but I'm not just going to spit something out. And it always seems to surprise people when you say that. Oh, I don't have all the answers at my fingertip. We have a huge research team and a lot of resources. Let me get you the precise right answer as opposed to an approximately wrong one.
I really appreciate you saying that, Barry. So as chief investment officer of my firm, we're a large firm like yours, and I'm often concerned about advisors, making up a response or wanting to sound confident when I think there's no more sign of your self-confidence when you're willing to say, I don't know, but let me get you that information. You even mentioned in the book at some point, I think, that learning to say, I don't know is a superpower. I mean, let's dig in a little bit more there. Why is that? And how do you get better at it?
So first, there's a couple of things that are sort of adjacent to it, but my favorite example is two examples, really. One is Enron, the other is Theranos. So Enron, you have an analyst during a quarterly conference call being told he's stupid because he didn't understand the business model, and what sort of a question is that? And really, when you see an answer like that, it means you've hit a nerve, and they're hiding fraud or something else, which is what was actually happening. So that guy, listen, I went to a state school. I didn't get an MBA, but that guy was like Yale undergraduate, Harvard, a Wharton MBA, not exactly a dummy. And so if Ken Lay is calling or Jeff Skilling is calling him, you must be an idiot if you're asking a question like that, red flags everywhere. That's a yellow card at the very least. And just like, wait, you don't like my question? As it turned out, what Enron was doing, and other companies had dabbled in this, is they would book like a 10-year contract, and then they would realize all of the revenue in year one, which is really not allowed. It just sends you off on this insane pyramid that. So the question they asked, not only did it get a terrible response, but it kind of accurately implied, hey, you guys are full of shit. This is a fraud. Theranos is even better. There's two things about Theranos, the blood testing company, that rather than draw a needle from a vein, would just do a little stick that all the medical professionals say, hey, when you do a pin stick, you're getting interstitial fluids. It's not a clean read. There's a reason we do a venal draw as opposed to, and I have no medical background whatsoever. And I
don't know any of this other than because of that story. I would have never known without
But
it.
here's the again, a couple of yellow cards, and you got yourself a red card, you're out of the soccer game. First, you have people like Henry Kissinger on the board of directors of Theranos, Well, I understand he's a big, important former Secretary of State / war criminal, but what's his expertise in biotechnology, medical devices, healthcare, etc.? Oh, and P.S., every VC that practiced in those spaces took a hard pass. So all the writing was there, and you're suing the Wall Street Journal because they're talking about this? Hey, another red flag. I interviewed the guy who wrote the book Bad Blood, Wall Street Journal reporter, John Carreyrou, I think it is. I love the book so much, and the interview was so great that before that interview came out, I wrote a book review for Bloomberg. And it published on like a Thursday or Friday. And I remember getting a phone call from the editor. Hey, we just got a nasty, threatening letter from, what's his name? The attorney that was also on the board of directors and owned stock in the company, David Boies. There you go. So I get this crazy phone call from the editor, and I freak out for about 30 seconds. And I'm like, wait a second. Every single thing in that, I don't know anything about Theranos. It all comes straight from months and months of, I think he won a bunch of awards, maybe even the Pulitzer for that series. Everything came from the book and the columns. So I now take David Boies' letter, which, it's in the other office. So I have a 2-page letter from him, and then I respond to the letter to the head of Bloomberg legal counsel, and the editor, literally line by line, annotate page 47, page 123, page. And so the general counsel from Bloomberg sends a response back to David Boies. That is the funniest legal letter you've ever seen. Shorter version, you are a schmuck. Come sue us. We will mop the floor with you. It was hilarious. And sorry, your problem is with the Wall Street Journal. All we're doing is reporting on the book, reporting on what the Wall Street Journal said. But if you want to sue us, bring it. It's just one of those things that, wow, this level of aggressiveness in defending what should be pretty straightforward quotes. You want my cash and you're not going to answer questions. There are 3,500 stocks. There are millions of small private companies and countless funds. Like, anybody who disrespects you in that way, move along. There's just no reason to waste your time or capital with someone who is going to challenge you because you're asking questions. And so, on the one hand, you have to just be intellectually confident enough that you're asking good questions. Doesn't mean you blow into a shareholders meeting having done no homework and start asking dumb questions that are in the 10Ks or whatever. But if you're like knowledgeable and you've done your homework and you ask a question and someone answers in a way that makes you uncomfortable, there are a lot of places where your capital will be welcome. This is not one of them.
Everything, just for our listeners, for our viewers, all these resources that Barry is mentioning, I'll be sure to link to in the show notes at thelongterminvestor.com. If you're watching us on Cheddar, be sure to subscribe to the podcast, subscribe to the YouTube channel. We're talking about a lot of the ideas that you can grab from Barry's new book, and talking about that book, How Not to Invest. A central theme of the book is inversion. It's even in the book's title. So talk to me a little bit about why inverting is so important, and how you apply it throughout your life in investment decisions.
Sure. So Bailout Nation comes out in the fall of the summer of 2009. And then we launched the firm in 2013, which was about a year or two work in prep. And I had a bunch of people pushing me, hey, it's time for another book. And my answer was, I'm kind of busy. And besides, there have been tens of thousands of how to invest books over the past, century. Most people are still pretty mediocre investors. I don't think the books are getting it done. And I kind of held everyone at bay for a while. And then during the pandemic, I don't know if you could see this on my wall, is a giant bulletin board. And I literally just started writing column, chapter title after chapter title. I ended up with 100 really short chapters. Most are a page or two, 3 at most. There's 1 or 2 chapters that are a little longer, 6-8 pages in the middle, and a lot of charts and tables. And as I started putting sort of pen to paper, just thinking about it. I don't want to say it's self-organized, but how not to invest quickly became 3 broad topics, each about a third of the book: bad ideas, bad numbers, bad behaviors. And then the last, I don't know, 5-10% of the book is, okay, I've told you everything what not to do. Here are a couple of things you probably should do. And I mean, that is really I don't want to say an afterthought, but you just can't be relentlessly negative for 350 pages. You got to give people a little something. And so the idea that it kind of teaching people what to do isn't working. So let's at least show them, don't do these things. I dedicate the book to a couple of Charlies. Charlie Munger, in the most Charlie Munger way, was once asked, are you and Warren Buffett just smarter than everybody else at Berkshire Hathaway? And of course, Munger says, it's not that we were smarter than everybody else. We're just less stupid, which is a pretty hilarious sort of Munger approach, but it's true. And then Charlie Ellis, who ran Greenwich Associates, the chairman of the Yale Endowment, board of directors of Vanguard. And Ellis sort of compares tennis to investing, where the professional score aces hit with power, accuracy, spin. They win by scoring points. The other 99.9% of us, we just make an endless number of unforced errors. We double fault on serves, we hit it long, we hit it wide, we hit it into the net, we hit it right into our opponent's sweet spot. That's how you lose, through unforced errors. And investing is the same. Hey, forget trying to pick the next NVIDIA. Just make less mistakes. You're way ahead of 90% of your peers. If being in the top decile doesn't appeal to you, what do you think you're going to do?
Yeah, I love Charlie's book, Winning the Loser's Game. He was actually on the show. For those of you listening, if you want to scroll back to episode 191, Charlie was on the show not all that long ago, and amazing how much fire he still brings to the table with these
80-something, 84, he's still cranking out books.
Yeah. He just he had a new one this year. It's on my bookshelf behind me. There it is. Rethinking Investing.
By the way, 87. I'm wrong, not 84. Yeah. 87.
Pretty amazing. And writing the forward to that is Burton Malkiel, who's 90-something. And
right.
We're all really fortunate to have been standing on the shoulders of giants. As you mentioned, there's a lot of books already on how to invest. You inverted that and say, okay, how do you not invest? There aren't that many original ideas anymore. I think the other thing is that, generally speaking, perhaps where I feel like the literature has expanded the most is the importance of emotional self-awareness for investors.
That's right.
You do a great job of covering this topic. Do you mind just sharing any specific example or strategies for how investors can practically identify and control their emotional impulses, whether it's during market turmoil or periods of excess and exuberance?
Sure. So one of my favorite little aha moments came from Laszlo Barigny, who's no longer with us, passed away a year or two ago. His shop used to put out, and you could create this on your own, but his shop used to put out quarterly and annual sort of just compendiums of various important, in quote, news stories. Headlines, Washington Post, Wall Street Journal, New York Times, just an array of stuff. It was just a headline and a handful of paragraphs. And it was page after page of this. And what's fascinating is when you look at news when it's old, it's not that it was inaccurate. I think people misunderstand what's going on. It's that you know how the movie ends. You know who wins the game. And so when you go back and reread these stories 6 months, a year, 5 years later, all that comes through are those shrieking emotional headlines that operate to throw you off of your chill, for lack of a better word. And so I got, back there in my office in the city, I got a bookshelf full of them. But you could do this yourself. You could just bookmark articles or just screen grab them and put them in a folder, and then once a quarter, once a year, go back and look at them. I mean, just stop and think about what it was like in the first quarter of 2020. The world is coming to an end. Everything is shut down. Here's a global pandemic. We're all going to die, only not so much. And The market sniffed out a couple of things before people had any idea what was really going on. First, that this was from outside of the economy and the market, a externality. I like to use the example, the asteroid that killed the dinosaurs, which history tells us exactly what happens when you have these externalities. Second, we had been working on mRNA for a decade, so being able to quickly identify what this was and to create a vaccine was very much in the offering. And then lastly, we had these giant companies with a global footprint that, look, when we launched our firm in 2013, I had a national media presence. So we had clients all over the country, having more or less been warning about the financial crisis and then not overstaying my welcome at the bottom. We had clients everywhere. And so we launched virtually. So Zoom and, slide shares and all these different things, screen shares, were second nature to us. It took people, it wasn't, we had this massive set of innovation in Q2 2020. All this stuff existed FaceTime was 10 years old already by the time the pandemic hit? And so all these things existed. It just probably accelerated broad adoption by, 3 to 5 years. So the market figured it out before everybody did, all these different companies. And it wasn't just Zoom and DocuSign and Peloton. It was really Apple and Microsoft, and go down the list. Netflix, obviously. We're not going to the movies. Netflix, yay. Home delivery, Target, Walmart, Amazon. So market really sniffed out what was going on long before the average person did. But the headlines from that period, just go back. You could use the archives for the Wall Street Journals or the Times or Barron's. They're horrifying. They're just shrieking. I used to jokingly say during the financial crisis, I wouldn't even be looking at a screen. I could just hear CNBC on in the background. And by how tense Maria Bartiromo was, I could tell you how much the market had dropped that day. Just her voice alone. And that was 08, 09. And while that was, a generational crash, similar to 73, 74, it's human nature. That's how we react. It's not. So my first thing is to recognize that the media, in its attempt to get you to click or watch or listen or read, to give them your time and attention, tends to really be emotional. I think that's the first thing you should do. The second thing is, the old joke is, we start as investors consuming everything, and as we become more mature and wise, we start filtering out a lot of things. And the recommendation I make in the book, and it's different for everybody. Obviously, I love my team and everything we do, but outside of my team, I put together, here's my all-star list, right? If I want to read, Morgan Housel did the foreword of my book, but I know Morgan for 15 years. We've been very friendly. I'm reading everything Morgan puts out. I love what Sam Rowe writes on market structure. Anything that Ed Hyman and ISI puts out is really intelligent, thoughtful, on-the-ground data. Jonathan Miller and Bill McBride on real estate, and on it goes. It's a fire hose of news, traffic, sports, weather, speculation, guesswork, opinion mongering. You don't have to drink from the fire hose. Just create your own all-star team. I have a post up on the blog today that's kind of relevant to this, and the name of the post is "Never Take Candy from Strangers." I come from the generation, I'm a latchkey kid, and all my parents wanted to know was, I had 3 rules. Make sure they knew where I was going after school, because back then there wasn't a million after school programs. Be home, hands washed and at the table by 6 o'clock, and don't take candy from strangers. Those were the 3 rules. The first 2 rules, technology has made obsolete, because your parents know where you are, to the foot, to the yard, through your apps on the phone. And you text your parents, hey, I'm coming. If you're a 14-year-old, a 13-year-old, hey, I'll be home at 6:15. We're running late. But never take candy from strangers is still good advice. Who are these people? What's their track record? How many cycles have they lived through? Are they more wrong than right? What's their temperament? Do they run around with their hair on fire? Or are they like, hey, this too shall pass. Just take a deep breath and don't do anything stupid. And so you find out really quickly who's worthy of your time, who's a catastrophist, always forecasting Armageddon, and who understands that everything moves in cycles and you can't assume that the world is coming to an end. That's been a losing bet for as long as humanity has been around. And when the world finally does come to an end, as the great Art Cashin used to say, it doesn't even matter because no one's going to settle your trade if you get it right. There's no one on the other side.
Well, I grabbed that URL to add to the show notes at thelongterminvestor.com. And, I've covered, you mentioned the book is divided into bad ideas, bad numbers, bad behavior, and good advice. I feel like I've spent a lot of time asking you questions related to the bad ideas and the bad behavior. Let me squeeze in one on bad numbers. Again, I credit you with introducing me to a lot of ideas for the first time. Just for context, I started my career in the summer of 2007. So my first bear market has been the only one I've found interesting because every 20% drop, I find myself saying, wake me up when we're down 30. And I remember watching the markets fall in 07, 08, 09 and thinking, oh, so this is just what a bear market is. This is totally normal, huh? And I've just now come to realize every bear market has felt very boring to me since. Little bit sidetracking here, but denominator blindness. That is something I distinctly remember reading on your blog. And I think it was around one of the election seasons, which, look, there's all sorts of examples of denominator blindness. But if I'm only going to choose one piece of your bad numbers content, I'd like you to focus in a little bit on how people are blinded by the numbers that are coming up in headlines. Give us some examples, give us some advice on how to think through those situations.
So probably the most extreme example of denominator blindness is selfie deaths. Outside Magazine ran a magazine story on 279 people died taking selfies over this 5 or 6 year period. And that number is out of context. I'll bring this forward to markets and economics in a minute. But all right, so how many? 279. What's the context? How do I frame that? Is that a lot or a little? And so it turns out at a Google I/O developers conference, there's something like 93 million selfies on Android taken every day. Every day. And that was 2015. So 10 years ago. So between Android and iPhones, between the global adaptation, what are there? Something like 5 billion smartphones taking 100 million selfies a day? You do the math, and the odds are greater that you're going to get hit by lightning and win the lotto the same day than you're going to die taking a selfie. Unless you're doing something incredibly reckless, like trying to take a selfie on the edge of the cliff and pretending to fall and then falling, or standing on a train and trying to jump off and not making it in time. There's endless dumb ways to die. It's just not the hundreds of billions of selfies that most people take every day. So let's bring that to the markets and the economy. I sometimes have the TV's always on and muted in the background. Sometimes I'll unmute it. Every now and then a headline will cross and it's like, this company is laying off 10,000 people. The market fell 500 points. Those two come up all the time. Well, 10,000 people, how big a company is this? This is a small local company with 20,000 people. They're laying off half their staff for a medium-sized company. That's huge. Is it Walmart? That means one person every 5 stores is leaving. And that probably happens once an hour, given how giant, what do they have, 2 or 3 million employees? Not knowing the denominator. Is it 10,000 out of 20,000? Is it 10,000 out of 3 million? That's a huge, huge difference. Same thing with market fell 400 points today. Well, was it the Dow? That's 60, 70 bips. It's not even a percent. That's normal trading. Normal trading is half a point up or down. Hey, if the S&P 500 is at 6,000 and the market fell 500 points today, hey, that's 8 or 9%. That's a big move. You need to know what you're talking about. And so just pulling one random thing out of context It's really misleading. I grew up, Jaws was a big book, and then it was a giant movie, and no one would go into the ocean. Jones Beach, as a kid, literally people were terrified to go in the ocean. There's something like 6 shark deaths every 3 years. Maybe there's a dozen attacks over the same time. We kill, depending on whose data you use, anywhere between 10 million and 100 million sharks a year. So really, if you're thinking about who should be afraid of who, right? But it makes for great TV. If it bleeds, it leads. Hey, coming into July 4th, there's always some story about some surfer that sighted a shark. Half the time they're dolphins and not sharks anyway. But, you know, the math is pretty incontrovertible. So I always like to, and we did the same thing post 9/11. People were terrified of terrorists. When you think about shark attacks and terrorist attacks, what you really should be thinking about is simply watch your blood pressure and your cholesterol. That's much more likely to kill you than either of the two by a factor of like 50,000x. Put your seatbelt on, and please don't text while you're driving. Don't worry about sharks or terrorists. The odds are wildly, wildly against it. And you could see those are such great comparisons, sharks and terrorists. Visceral, emotional, oh my God, versus, wait, I have to worry about my cholesterol? How much more? Now, apply that to investing. It's not market crashes or hyperinflation that's going to do you in. It's dumb little things like fee structures and overtrading and chasing the late, great, whatever the hot fund of the moment is. It's the blood pressure and cholesterol. It's not the terrorism.
Oh, that's fantastic. And I appreciate you going into detail of some of the denominator blindness piece. You know, a lot of times I feel like my job when I'm working one-on-one with a client is to help them sort through facts that aren't always relevant. You know, whether it's an investment thesis for or against something, and I'm being told a lot of facts, I'm like, those are all factual things. Do they actually matter? And you need a lot of context. And I think what a really good advisor does is that they can be objective and look through those things. And kind of touching on the one section we haven't spent much time on, which is good decisions that you can make. One of the chapters you have in there is getting good advice. So let me ask you this, Barry. You and I both, I think, have a lot of do-it-yourself investors who follow us. Why would you tell somebody who takes a lot of interest in investments and is constantly following things, why would you tell them to go ahead and hire somebody to help them out?
So first, I just want to roll back a little bit. When someone brings something to your attention, one of the questions I always like to ask clients are, all right, so you read this in the Wall Street Journal. Do you think everybody who owns this stock or has an interest in the stock or bond market has read this also? Yes. So isn't it fair to say by the time it makes it to the front page of a newspaper or a cover of a magazine, isn't that already in the stock price? Like, the idea is, tell me something that everybody who owns this stock doesn't know. So that's number one. Number two, our whole business model is kind of backwards. Like, we don't have an institutional trading desk where we're swapping research and taking order flow. Our whole model has always been, hey, we have a lot of great content. Here it is for free. By the way, some tiny percentage of you don't want to do it yourself. For the 0.01% of you who need some assistance because your situation is a little more complicated, we're happy to help. So I've always, the really weird thing is, it was never my intention to launch an RIA, to build a practice. I started on a trading desk. I had always been on the institutional side, and I had just been so frustrated by seeing the sort of bullshit that gets pumped out by everybody from Wall Street to the fund industry to the media, it was just so frustrating. And so finally, literally, it was just like, I'd been turning money down for a while, and a friend said, you don't know how hard it is to raise capital. If people are reaching out to trust you with their money, well, rather than turn them loose to the wolves, see what you could do for them. And so that was the genesis of Ritholtz Wealth Management, where our last ADV was 5 point something. Given the market the past month, we're probably around $6 billion. And so what started is just all right, I'm going to show you the right way to do it. So if you need, if you don't have a complicated situation, if you're just saving for retirement, That's simple. As my buddy Dave Noddick likes to say, investing is a problem that's been solved. Own a broadly diversified portfolio of low-cost, preferably diversified international and domestic equities. Rebalance every couple of years. See you in a few decades. So that's the really simple thing. All right, you get married, you have kids, you have a mortgage, maybe you have some capital gains from employee stock or this, and now it's a little more complicated and maybe you need some help with tax. Find a good fiduciary accountant who's going to help you do this. All right, so wait, now maybe you have founder stock, IPO stock. Now things are starting to get a little more complicated as you move up the complexity. It's not the wealth ladder. It's the more complex, the more moving parts. Hey, maybe you might need a little expert advice. If you need that, I like to tell people, make sure the person you hire is more like your lawyer, accountant, doctor, and less like the guy who sold you the used Toyota, right? It shouldn't, because essentially the traditional Wall Street suitability standard is not especially suitable at all. I like to describe it as don't sell pets.com to grandma. That's suitability. As opposed to hire someone who has your very best interest at heart, and everything they do is aimed in that direction. And so if you have the temperament and the interest and the time, by all means, do it yourself. Thanks to Jack Bogle and Vanguard and BlackRock and a lot of other firms, amazing products, 4 or 5 bips, so cheap. Trading is free, meaning executing your purchases are free. It's the golden age of investing, even though all you read about is people whining about how terrible everything is. Amongst investors, forget the rest of the world, just amongst the investor class. And then second, if you're not interested or you need some more help because your circumstances have grown more complex, well, find somebody who can help you. It's pretty straightforward stuff. I never set out to be like a walking advertisement for the CFP industry, but we have 31 certified financial planners. Everything we do is married with a financial plan and then a portfolio that reflects that plan. I don't remember if it's even in the book. I talk about, but I've written about purposeless capital, not purposeful, purposeless. Bill Huang and Archegos, and how this guy left the hedge fund with $1 billion, just went crazy with leverage and derivative, ramped it up to $20 billion, and then crashed and burned, took it to zero, and got a few felony indictments for his trouble. That's purposeless capital, just going for more. On the other hand, if you know what you want, retirement, saving for your kids' college, philanthropy, whatever it is, when you have a purpose, well, then you could marry the appropriate risk level to that purpose and get to where you want to go in the easiest, least stressful way. I'm always shocked that people have a hard time with that.
Well, Barry, I agree with you on that response. Very, very thoughtful. And I'm so appreciative of you sharing your time and wisdom with the audience today. In case people don't make it over to the longterminvestor.com to find links to all your stuff, where should they be following along to find all your great work?
So most of what's in the book started out as little nubs. So you can find that at Ritholtz.com. The firm is RitholtzWealth.com. If you want to learn more about the books, see some other stuff, all the various blurbs and things, that's at HowNotToInvestBook.com. But Google me. I'm really not that hard to find. Masters in Business ends up on the blog. At the Money ends up on the blog. Anything I've done for the Washington Post or Bloomberg will ultimately end up at the blog as well.
Just another strategy that I also copied off of you. So Barry, thank you for your time. Thank you for the influence you've had. And to everybody watching, be sure to like, subscribe, comment, do all the things that help others find this show and learn from our wonderful guests. Barry, thanks so much. And to all of you listening and watching, to Long-Term Investing.
Thank you, Peter. Really appreciate it.